Hello. We will continue our discussion on the economic value added. In the last session, we discussed about the accounting adjustments. Let me now shift my focus the use of economic value added. Managers often ask that how to use, what is the relevance of economic value added. If you see, economic value added has three important components: net operating profit after tax, popularly known as NOPAT, capital employed, and the other one is a weighted average cost of capital. If the net operating profit after tax NOPAT is more than the capital charge, then the company is said to have generating profits or wealth for the shareholder. But now let us try to analyze these three terms: NOPAT, capital employed, and WACC. EVA is a function of or depends on the NOPAT, capital charge, and WACC. Now WACC reflects the financing decision. In other words, WACC is a weighted average cost of capital which depends on the debt equity ratio of the company, and the debt equity ratio of a company is a reflection of the financing decision of the company. We know that if a company finances its business with a debt, the cost of debt, since is lesser than the cost of equity, there is a possibility that the WACC may be lower. Or in other words, by changing the debt equity ratio or the financing decision, it is possible to change the weighted average cost of capital. In the process, it is also possible to change the capital charge. However, capital charge also depends on the capital employed. Capital employed is a reflection of the investment decision, because capital employed is equal to the total assets of the company minus the current liabilities. In other words, it shows how the assets have been financed by the debt or equity. That means if the assets of the business are large, the capital employed will be large. So by managing the investments of the company, it is possible to manage the capital employed. So capital employed can be managed by investment decisions. WACC or WACC can be managed by managing the financing decision, and the net operating profit can be managed by managing the operating decisions, because net operating profit after tax and before interest reflects the operating profit or the profit generating ability of the business. So it can be managed by changing the price, by managing the cost, by controlling the overheads and incidental expenses which are necessary to earn the profits. So NOPAT can be managed by operating decisions, WACC can be managed by financing decision, and capital employed can be managed by managing the investment decision. Therefore, if you see, EVA is a function of operating decision, financing decision, and investment decision. But somebody can say that same is the case with ROI, the normal accounting profits. Answer is yes. But unlike ROI, as we saw in the previous discussions too, EVA considers the entire cost of capital. That means both cost of debt as well as cost of equity. So if the focus of the business shifts from managing ROI to managing EVA, that means we are not only considering the operating cost, but we are also considering the cost of capital, which includes the cost of debt as well as the cost of equity. So therefore, if the management tries to manage the EVA, it is possible to keep a watch on the operations, it is possible to keep a watch on the financing, it is possible to keep a watch on the investment decision. For example, few years back, when Tata Steel, the new CMD took over, he said that we want to become a positive EVA company. In the process, he wants to send a message that we want to concentrate on operations, we want to manage our finances, we want to manage our investment, in the process create the wealth for the shareholder. So to summarize, EVA depends on all the three decisions, and EVA can be managed by managing operations, investments and financing. Thank you very much.